Hi, my name is Jason Watson with the Watson CPA Group, and today we're going to talk about end-of-year tax moves. Hopefully it's not January 3rd and you missed all this. So we're recording this in September. John, hopefully they have enough time to process this. So anyway, end-of-year tax moves for business owners. The very first thing we want to do is talk about the value of a tax deduction. Cash typically has to leave you for you to get a tax deduction. Kind of in a theoretical sense, someone else's income is your deduction, or for you to have a deduction, it has to be someone else's income. So you have to go buy something or you have to spend something, okay? So what is the value of a tax deduction? Look at your marginal tax rate. Let's say you're sitting at 22%, 24%, and you spend $10,000. Let's say you're at, again, 24%, you spend $10,000, you're going to put $2,400 in your pocket. Basically, that $10,000 expense is going to cost you $7,600. Okay, so don't think that you spend $10,000 and it's like fake money. I hear so many times at parties and other get-togethers where people say, it's a write-off, it's a write-off, it's a write-off. It's like, yeah, but it's not monopoly money. It's still real money leaving your body, and you only get a little bit of that chunk back as a tax deduction. So don't just run out there and buy stuff just for the sake of saving taxes. That's theoretically silly. So now let's move on to the equipment vehicle purchase. So you've understood the value of a tax deduction. You're like, yeah, okay, I'm good with that. And now I want to go buy something, Jason. Okay, so people call us up all the time in December and they say, hey, should I go buy a car? And I'm like, okay, do you need a car? That's the very next thing we're going to ask. And if someone says, nah, I just want the tax deduction, I'm like, stop. We don't buy things for tax deductions. We buy things for operational considerations. Do you need a car? Do you need a copier? Do you need to buy whatever is on your mind? If that is a yes for operational considerations, then let's look at the tax implications. But do not run out there and buy stuff just for tax purposes, okay? If you need it, that's cool. We'll give you thumbs up, but we're not done. We'll say, all right, how is this year compared to next year? We're sitting in December. Is this a bang up year where next year maybe won't be as good? Or is next year much bigger? You got a lot of things in the hopper, a lot of contracts are gonna be coming in over the next year. Maybe we hold off on that tax deduction. Yes, I understand you want a bird in the hand versus two in the bush, but please wait a year and get more out of that tax deduction. If you spend $10,000 at a 24% marginal tax rate, or if you wait and you're at the 32% marginal tax rate, you just made an extra $800 by waiting. Okay? So we're gonna ask you, do you need it? You say, yeah. We're gonna say, how is this year compared to next year, and if next year is going to be better, then maybe we delay that deduction. And if this year is really big and next year is going to kind of be on the slower side, then yeah, let's write that check on 12/31, okay? So 12/31 or January 1, all depends on what you expect for income. Now it's tough. If you're a realtor, if you have some lumpy businesses out there where it's hard to predict what your income is going to be, yeah, then buy it now, okay? Because personal satisfaction and all those intrinsic things are still good things to have. But if you do have good prediction, then maybe you want to kind of make the today versus tomorrow assessment. All right, now once we think we need it and we know we need it now because we're humans and we want things now, do we want to depreciate over time or take what we would call an instant depreciation via Section 179 or bonus depreciation? It's 2019, so if you're watching this video 10 years from now, this won't make sense, but right now we have 100% bonus depreciation going on. So we can either take 179, typically take instant depreciation for the full value of the expense. There are some rules, of course, or we can take 100% bonus. However, you might choose to depreciate over time. What I don't like to necessarily see is take all your deductions now, and then 2, 3, 4 years from now when your business is really booming, you're rocking it, and now you're kind of naked out there, if you will, from an income perspective, and you don't have enough deductions in your pocket because you took them all before as instant depreciation. So I know that's hard, but sometimes we do want to elect to depreciate over time so we can match deductions in a higher income year. We just leverage our deductions better by waiting. I know we don't like to wait, I get it. All right, so equipment, we kind of beat that one down. We can also prepay expenses. You can prepay rent, you can prepay maybe insurance, you can prepay some other things, maybe buy some copier paper, ahead of time and all that stuff. Just be careful, of course, the time value of the money that you just spent. But you can do that. Typically, you can't prepay things more than 12 years in advance. Okay, there are some rules on that. Get a hold of us, we can help out. But prepay expenses is certainly another option for you at the end of the year. And this, again, this would be that whole 12/31 versus Jan 1 argument. Why prepay expenses for this year if next year is going to be just that much better? Sometimes you find yourself in these circular references because you're robbing Peter to pay Paul. Next year you're doing the exact same thing, even though the following year is going to be bigger. So try to have some patience and some due diligence when you determine how many expenses you want to try to prepay to reduce your taxable income this year. Process bonuses and profit sharing. If you've already going to give somebody a bonus in January, and again, this year is better than next year, maybe just give it to them in December. It's Christmas time, be nice. And also, we can look at charity. It's weird, if you are a pass-through entity like an S-Corp or a partnership, that business can give away stuff. It can haul its old furniture down to Goodwill. It can give away other things and have that be a charitable deduction for you individually as the owner of that business on your Schedule A, on your Form 1040. So don't forget about business charity. We always kind of think about cleaning out our attic and dropping off a bunch of things that we don't need to Goodwill. Well, businesses are addicts too. They kind of grow weight and clutter like any human does, and they could maybe afford to give away some things to charity, get a tax deduction, and help some people at Goodwill be put to work. Anyway, these are end of year tax moves. There's all kinds of other things to consider. These are the big ones that we deal with every day. So give us a call. My name is Jason Watson, Watson CPA Group. Again, call us, email us, look at us on the internet. You can also read our book. We discuss a lot of this stuff as well, and love to help you. Thank you.